It's Sunday, July 25th, 2021. This is all about your Benjamins and your weekly mixtape and weekend review video. Hope you had a great week. Let's get straight to the headlines that may or may not be impacting your financial plan and portfolio. Keeping it short and sweet this week. We're going to start off in the jobs market, and last week there was an unexpected tick up in jobless claims. The expectations were in the 380,000 range. It came in around 415,000. So that was not expected. I don't know what that means. I don't know the reason why. Nobody really knows why. And we'll have to see if this is a one-time thing or if this is a trend that is going on. My guess is it's one time, and we may not know exactly why that happened, but when you look at unemployment numbers still low, you look at the number of people collecting benefits decreasing. So we had a tick up in jobless claims, but people who were already collecting benefits, more people rolled off not taking benefits. So we kind of had both ends of the spectrum show. New people up, but people who are collecting benefits go down in the same time period. So an interesting dynamic there. Just something to pay attention to. And again, we look at this from time to time just to have an idea of what's going on. So we'll keep monitoring that. Next, I want to go to the big sell-off that happened late last week. Monday rolls around. Was that the Monday? I forget exactly what 2 days it was, what days they were. But the point of the story is there was a big sell-off in the market. The markets were down over 2%. Big numbers on the Dow. We see 900 points down throughout the course of the day. I think it ended down around 700. And those numbers begin to make us uncomfortable. But very quick snapback, and within 2 days we were back above where we were. I bring this up not to talk about why the decline happened, because we don't know. People talk about variant or the Delta variant of COVID. Talk about inflation numbers up there. All these reasons as to why this happened. Could just be the market was up pretty good for the first half of the year. These headlines gave a reason to take some gains. People reestablish their positions and get back to it. We'll never know. But what I want to bring up is just the fact that it would be very easy to let those headlines and then that dramatic fall in one day spook you and move to the sidelines. This is not investment advice. Consult your financial advisor. Have a financial plan that guides your investments. But very rarely is the best course of action to sell when there's a big sell-off in a day. The best course of action usually, historically, I believe will continue to be the case, is to stay with your investment plan. You are diversified, hopefully. You have stocks and bonds, hopefully, which allows you the opportunity to not react to these headlines. Trading in and out of the market is a very hard thing to do. It's not impossible. There are some people who can do it. I am not one of those people. I don't want to spend the time trying to do that, and I don't want that stress of trying to get it right. So many people may have sold off and moved out of the market because they were scared, and maybe they still would end up being right, but there was a very big snapback, and they would have missed that recovery most likely, or missed some of it, locking in some of those losses. So again, I think a very prudent way to invest is to have a diversified portfolio. Don't react to the headlines. If you want to have some tactical investing in it, moving average, trend to following type stuff, that's good as well, mainly because it's not reacting to headlines, it's using moving averages, or there are triggers to make a sell, not a headline, not a one-day move, usually for us long-term investors. So the point of this article, this story and bringing it up was to remember not to get emotional with your investing. Hopefully you're investing for the long term. If you have short-term funds, this is a reason why maybe you shouldn't have it in the market. But if you're looking 10, 15, 20, 25, 30 years out, days like the day where the market was down a couple percent should not take you away from your investment strategy. Sticking with investments, I would just bring this one up. The Dow crossed 35,000 for the first time, and it was a relatively quiet event. Sometimes when we hit these milestones of nice round numbers, we have hats, it's a big deal, but 35,000 came in, and we'll probably fall back below and get back above it again without a lot of noise. And I think that's a good thing. It just means that we're not getting too excited about numbers that are really just arbitrary. We would expect that as time goes on, we'll see 36,000, 37,000, 38,000. It's kind of like once you've been there before, act like you've been there before. Score a touchdown, act like you've been there before. Break through a new 1,000-point level, act like you've been there before. And another thing that makes this less exciting is, as you think about it, as we go up in numbers, 1,000-point move is a lot less. It's a smaller percentage. 1,000 from 35 to 36 is going to be less exciting at 34 to 35, a percentage way. It's a smaller percentage. It takes less time to get there because of compounding on bigger numbers. So the point of it is also that I think it's a good thing that there's not a lot of irrational exuberance out there. We talk about cycles of the investing market, and there's this height where everybody is very excited, and it's irrational exuberance is what they call it. FOMO is getting the best of everybody. No one's really feeling like they missed out on 35,000. I don't see a lot of people overly excited about it. So I think that's a good thing when you think about the mood of the market and are we too excited about what's going on. That would be a little litmus test for me that would say, no, we're not too excited about what's going on in the market. It was very quiet as we crossed that threshold of 35,000. So we'll keep on watching it. Hopefully 36,000 will come and go and no one will make a big deal about it, and we keep moving ahead, focusing on other things. The next two headlines aren't really financial planning, but just things to talk about. The next one is Elon Musk talking about Tesla holding Bitcoin and also SpaceX. There was a meeting of the minds between Cathie Wood, Elon Musk, Jack Dorsey from Twitter, and they were talking about Bitcoin, and he disclosed that they were still holding it. I only bring this up because there was a period of time where Elon Musk was impacting the price of Bitcoin and Dogecoin at the same time, and I want to bring this up just to encourage you not to make investment decisions based off of famous people making comments. I think it's actually a negative thing or an unfair thing for Elon Musk to be able to talk about these headlines, make these headlines about investments and move the price when he's owning the underlying investment. As a financial advisor, I couldn't do that. As a regulated investor, a lot of other people are not able to go out and say these things to influence the price. Yet, since he's not a investor, technically, he is able to kind of to say these things and have less recourse than those of us that are professionals. And I don't think anybody should be trying to sway the markets by saying things, but he talked about how Bitcoin was bad for the environment and he didn't want to hold it. He was touting Dogecoin, and then he's impacting the prices based on his headlines. I don't think investors should react to those headlines, but it's what happens. So anyways, I want to bring this up is that he was negative on Bitcoin. He talked bad about it. He talked up Dogecoin, yet he is still holding Bitcoin on the side. So did he buy more Bitcoin when the price went down? We'll never know. But you just have to kind of take what these famous people say. Mark Cuban is another person who's out there talking regularly about this. Take it with a grain of salt. Stick to your investment thesis, why you believe in it, why are you investing in it, and tune that noise out. Don't make your decisions because Elon Musk says one thing or another. And finally, there's an article in the Wall Street Journal about FICO scores and how they're becoming less and less important in the eyes of lenders, which I think is a good thing. I understand why they exist. There's got to be a way to measure someone's creditworthiness, but the FICO score really has frustrated me over the years because you can do good things. You can pay off debt, and then your FICO score goes down, which means your borrowing costs go up, and you're negatively impacted by doing the right thing. Keeping credit cards open just so you have available credit. It's a game. It's also a game that keeps people away from being able to have access to credit. So whether it's intentional or not, that's up for debate, and I'm sure we have studies out there. The FICO score has also limited a lot of people from progressing and getting access to capital to maybe start a business or buy a home or better their lives when they would be qualified people. They would pay the loans back, but because of one reason or another, having limited credit history or not being able to get a credit card, they're unable to get credit to help them get this. Kind of like when you go to get your first job, well, you need to have the experience. Well, how do I get the experience with the first job? How do I get that good credit score without having access to credit? And the scores kind of prohibited people from growing. So I'm all for seeing the FICO score be a part of what is a decision, but not the end-all, be-all. And it'd be interesting to see what these banks and lenders are using for judging whether or not they're going to extend credit to people. But more information is available out there. I do think this is an opportunity where blockchain technology, it doesn't solve everything, but blockchain technology could be something that's used. We could all create our own credit profiles. Net worth could be disclosed in there, and it would only be private and be sent to the bank so they could see a big picture of, okay, this person may not have a lot of credit, but they have a lot of assets. They've decided to grow their assets without having to leverage debt to do so. So while they may not have a long credit history or have very limited amounts of credit available to them, they are worthy. Or there could be other programs that come out of this. So I think this is a good step in the right direction, but I want to also hope that whatever is used to help make these decisions is not as prohibitive as what the FICO score has been in the past. Again, I don't disagree with there needs to be a way to measure someone's creditworthiness. It's just how is it being done and what factors are being taken into consideration, and is there a way to give people access that they didn't have before, and then move forward that way. So that is it for this week. A little bit of rambling, a little bit of soapboxing from me, but I like to do that from time to time. So hope you enjoyed. Again, comments down below. You've got the mixtape to read. Head on over to All About Your Benjamins if you're on YouTube watching this. Thank you as always for watching and supporting. Have a great week, and we'll see you all in the next episode.